Hi, this video is the third video for Lecture 4. In previous videos, we introduced real interest rate and we discussed how expected inflation rate will affect real interest rate. In fact, we have many factors that affect real interest rate. For example, your preference for consumption today will affect real interest rate. When we talk about preference for consumption today, we are talking about how you make trade-off between consumption in the future and consumption today. Generally, you are impatient, so you prefer consumption today. We also think supply and demand for money will affect real interest rate. For example, the market situation in credit market will affect real interest rate. We also think risk will affect real interest rate. For these three factors, we don't think you need to consider this when you make investment project valuation. But for the first factor, we think it is a big deal. And later in this semester, Jesh will help you to measure risk and value risk in corporation investment project and also in stock valuation. I want to emphasize we need to be consistent in choosing interest rate. If you are solving a problem related to cash flows in nominal dollars, then you will want to use the nominal interest rate to do the compounding and discounting. If you are solving a problem with cash flows in real dollars, then you need to use the real interest rate. In short words, try to be consistent about your cash flow and the interest rate you are using. In the beginning of this course, we introduced the concept of time value of money with the interest rate of government bond. But in market practice, we have government bonds of different maturities. For example, you have 3-month treasury. You also have 10-year treasury. The truth is, the interest rate of government bond of different maturities, they are different. So the interest rate of different maturities are different. If we draw a graph of this interest rate and its maturity, then we have this graph called treasury yield curve. You may find treasury yield curve is a hot topic in business news. Then naturally we ask the question, what will affect the shape of yield curve? Well, we have many discussions and theories about explaining the shape of yield curve. Generally, we think investor expectations, risk premiums, liquidity, demand and supply of money, and arbitrage of investors will affect the shape of yield curve. But we haven't reached a full consensus in explaining the shape of yield curve. But these theories are very helpful for us in thinking about pattern of interest rates over time. Now I want to introduce the description of shape of yield curve. If we say the shape of yield curve is normal, we are talking about the long-term interest rate higher than the short-term interest rate. If we say the shape of yield curve is steep, then we are saying that the long-term interest rate is much higher than the short-term interest rate. If we say the shape of yield curve is inverted, we are talking about the short-term interest rate higher than the long-term interest rate. Sometimes we say the shape of yield curve is flat, then we are talking about the fact that the long-term interest rate and the short-term interest rate are similar. Here we provide some graphs of these yield curves. In the first graph, we can see that the short-term interest rate is lower than the long-term interest rate. We say this kind of yield curve is normal. But in the second graph, we can see that the short-term interest rate is much lower than the long-term interest rate. We say this yield curve is steep. In the third graph, we can observe that the short-term interest rate is higher than the long-term interest rate, then we say the yield curve is inverted. After this lecture, we are going to make bond valuation, stock valuation, and project valuation of corporation. Then we will meet a lot of terminologies about the required rate of return. For example, in bond valuation problem, we call it as bond yield. In the problem related with stock valuation, we call it expected return or investor required return. In project valuation of corporation, we say it is opportunity cost of capital. Though we have different terminologies for this required rate of return, the idea behind these terminologies are similar. So we use these different terminologies to describe the minimum required return for an investor to do this kind of investment. I want to provide more details about opportunity cost of capital. When we make business decisions, generally they contain uncertainty, or we say that they are risky. Then we try to find an appropriate discount rate to evaluate these kind of business decisions. But for most of the time, it is difficult to find a direct measure for these discount rates related with cash flows of with risk and uncertainty. So then we try to use the opportunity cost of capital as the measure. It is the best available expected return we can find to evaluate an investment. And we try to use this measure based on a comparable investment. For example, they have similar risk and term structure. For example, in 2013, Caribou is privatized. So Caribou was no longer a public corporation after 2013. We cannot find the stock price for Caribou after 2013. Then if you want to make an investment in Caribou, how can you discount the cash flows from this Caribou investment? An appropriate or a feasible measure here for this opportunity cost of capital we can use. You can consider using the Starbucks, or you can consider another large coffee shop, and that you can observe the stock price to use this as measure for the opportunity cost of capital of Caribou investment project. Okay, now I want to wrap up for lecture 4. So in this lecture, we talk about the effective annual rate, and we compare effective annual rate with annual percentage rate. And we also talk about real interest rate and factors that affect real interest rate. One tip for solving problems with this interest rate, you want to be consistent about the cash flows and the interest rate you are using. And after this lecture, I hope you are well prepared for the future chapters in bond valuation, stock valuation, and project valuation. Thanks.